All right. Well, I think that's enough patience from my end. So as people continue to scroll on, I just have some logistics. Good afternoon. We're very excited for today's conversation. My name is Brian McGann. I'm the head of investment strategy here at Beacon Trust. Joining me today is Lizanne Sonders, the chief investment strategist at Charles Schwab. I am sure that every participant on this call is familiar with Lizanne. Her commentary on financial networks like Bloomberg, CNBC, quoted in many financial press, Wall Street Journal, so forth. So Lizanne, we can't thank you enough for spending some time with us this afternoon.
Thank you.
Logistics, everyone is on listen-only mode for the duration of the call. Questions as they arise can be typed into either the chat box or the Q&A tab. And for compliance purposes, the disclaimer that we used to show is now needed to be read. So the content being discussed during the webinar is for informational, educational purposes only, should not be considered a recommendation or personal advice. A reminder that all views expressed on this webinar are that of the program participants and are not intended to be a substitute for personalized professional financial advice. Please reach out to a member of your Beacon team. Please note that certain program participants may also have a relationship with Beacon, which may present a conflict of interest. You can view more information about Beacon and its conflicts of interest at the SEC's Investment Advisor public disclosure website or investor.gov. I wish I could read faster. Anyway, so let's get to the content because there is plenty to discuss that's happening, and it seems like we have a relatively good financial market in the face of lots of headwinds. So, Lizanne, just really from a 30,000-foot view, the economy seems to be in relatively good shape. Financial markets obviously reflecting a much more positive attitude, again, in the face of what we would consider relative headwinds. We've had, a cycle over the past 2 years of high inflation, aggressive rate hiking cycle. Now it looks like we're entering the opposite. Inflation's moderated quite a bit, although still a little bit of work to be done, but the focus has shifted. So I know that you've commented a lot on both the strength of the economy, the employment situation, so we'll touch on a lot of that. But where do you think that we currently are here in this cycle?
So in terms of the economic cycle, this has obviously been an incredibly unique cycle that has not a lot of comps in history and lots of cross currents associated with it. And I'm certainly not going to go back the last 4.5 years and rehash the whole COVID era, but I think it's important to think back to the early part of the pandemic to just lay the groundwork for what has made this cycle unique. We, of course, had everything shut down, locked down, the stimulus kicked in, we had pent up demand. But that was all funneled into the goods side of the economy because services were completely shut down. That sort of started not just the improvement in the economy, though concentrated in goods, it also started the inflation problem that really peaked in earnest in 2022 on the goods side of inflation. But fast forward, we actually had hard landings, recessions, sectoral recessions in manufacturing and housing related, and some of the consumer segments of the economy that were, stay at home beneficiaries. We went from hyperinflation in those goods categories ultimately to where we are now, deflation in those categories. We've just had the later offsetting strength on the services side of the economy. Also in the services or non-goods related categories within the inflation metrics. Services is a larger share of the economy. It's a larger employer, helping to explain the resilience of the labor market. So I think on a look forward basis, this ongoing debate of recession versus soft landing sort of misses the nuances of this cycle, given that we have had hard landings in those aforementioned areas. We just had this elongated time cycle where the strength and weakness is sort of rolled through, as opposed to the weakness happening all at once and then the recovery happening all at once. So I think we could continue where at a point where services maybe has its day in the clouds, that we may actually be in recovery for some of those segments of the economy that already took their hits. And we can talk about it, but that also translates into some of the cross currents and bifurcations that have happened in the stock market too. There is a relationship there.
Yeah, I think that, that was a concept that you had discussed, the rolling recession concept,
Right,
that, certain sectors went through recessionary periods, even though we still haven't gotten a declaration of recession
right.
from the NBER. And that's been, a unique start to this 2-year bull market,
That's right.
one that we haven't had in quite some time, where it started obviously at the end of a bear market, but not in the face of a recession. So
Right.
do you think the Fed recently, I mean, has over the past couple of months has really changed its focus from the inflation fight, not declaring victory, but really changed its focus on what was potentially a very weak labor market, although the last labor report was actually pretty robust. Um, I mean, is there a scenario that you can see where the labor market continues to be relatively good and the Fed continues to cut rates to stimulate?
Well, so in the aftermath of the combination of the better than expected most recent jobs report and slightly hotter than expected inflation via the consumer price index, you basically saw the probability of the Fed doing another 50 basis point cut come completely off the table. You can look at probabilities through websites like the CME Fed Watch tool, and you can Google it anytime, and it just shows you what the current probabilities are. And those probabilities are based on the Fed funds futures market, basically what the market is pricing in based on positioning. And there's even still, albeit small, a percent probability, it's sort of, I don't know, 10, 11% as of last time I looked, that the Fed actually won't do anything. But I think that would be only if we got data between now and the Fed meeting in November that would be supportive of that, which would probably be some combination of yet more positive labor market data and not a turn back down in some of the inflation metrics. Barring that, I think the Fed does view it having started a cutting cycle, but we were of the view, even before the latest better jobs numbers, that the Fed's decision to go 50 basis points out of the blocks was not an indication that they were going to approach every meeting with that level of aggressiveness. I think what ultimately the calculus was at the September FOMC meeting was what we learned from the Fed minutes related to the July meeting was that there was more discussion about whether it made sense for them to cut in July. There were voting members that said, we think we should cut. So they sort of just, you know, blended some of the desire to cut in July into September, sort of recalibrate, given inflation had come down and therefore real rates were high, and just kind of do an insurance cut or a bigger, we mean business, but it should not, and they subsequently confirmed it doesn't represent an all clear for that level of aggressiveness. And the last thing I'd say is one of the things we've been consistent in saying is be careful what you wish for if you're hoping for a Fed that cuts aggressively. That is not typically rewarded by the market. In the past, when the Fed has been cutting aggressively, somewhat obviously, or it should be anyway, they're cutting because they're trying to combat a recession or a financial crisis, some combination thereof. So a more methodical, slower Fed, I think, is actually a better backdrop for the equity market.
Yeah, I think it probably gives consumers a little bit of that comfort that there's nothing they're missing,
Right,
right? If the Fed goes ultra aggressive, what am I missing?
right,
There must be an emergency somewhere in the economy. And different than other cycles, I think we would agree here that um, don't really see much stress in the system. It's not a
correct.
credit issue. It's not a
Right.
leverage, consumer issue. The consumer, again, continues to be robust, and we'll get some sales data tomorrow. But it seems to me that even with an employment market that has been tight and again relatively robust, it seems like there's a little bit of that spending pullback at the service level. Maybe that's just the nature of an election cycle coming up, and people a little bit unsure of directionally where we're heading. But again, that also translates into some of the confidence numbers. I know you do a lot of work on consumer confidence and sentiment. It's two different things. Um, and that really hasn't been reflective of markets hitting all-time highs every other day, basically. So, is the consumer leverage level, is that holding back a little bit of the spending that we could see a little bit more robust growth?
Well, I think, the analyzing the consumer right now shouldn't be done via monolithic lens. I think it might have been appropriate during the stimulus era in the early part of the pandemic, where savings rates pretty much across the spectrum of consumer income levels went through the roof. And then maybe even in the sort of drawdown phase of some of that stimulus, you could look at the consumer monolithically. That's not the case anymore. Whether it's attitudinal measures of consumer confidence. For instance, the Conference Board's measure of consumer confidence, which comes out monthly, in addition to just a headline confidence reading, they break it into four income zones, and maybe no surprise, only the highest income zone has been experiencing rising confidence. The three lower income zones all in declining confidence. You're seeing it in spending behavior. You're seeing much more constrained spending down the income spectrum, less so up the income spectrum. The excess savings has, by most measures, been fully drawn down, call it the bottom two-thirds of the income spectrum, where there's some excess savings probably still swimming around up the income spectrum. You're seeing problems in on the lending side of things with defaults and delinquencies, but really more acutely being seen down in that sort of subprime category. And so I think you have to have a bit of a fine-tooth comb to analyze the consumer. I really think, though, what's interesting is the feeder from the labor market and confidence in the labor market into consumption helps to explain why, in terms of things like consumer confidence versus consumer spending, the latter has been more consistently strong than the former would suggest. So we have been in this backdrop of, yes, listen to what they're saying, but maybe pay at least as much attention to what they're doing. And on a look forward basis, it comes back to the labor market. And I think that the Fed is acutely aware of this and why their focus is a bit more on the labor market. That I think a weakening from here in the labor market, it's not necessarily our base case, but my job is to think about risks and, best and worst case scenarios. If the labor market were to weaken more acutely, I think that would probably feed fairly quickly into consumption related data. But as long as the labor market stays fairly healthy, even though savings rate is on the lower end of the historic range, the excess savings has been drawn down, it's that confidence in the labor market that has kept consumption healthier than what the confidence readings would suggest.
Yeah, definitely evidence of a different spending pattern, right? I think a little bit post-pandemic was I'm traveling, I'm doing things that I wasn't able to do. Focus now shifts on, well, I need to spend on what I need
Right.
to spend
Needs
on.
versus wants. And you know what's interesting about that, Brian? If you break the consumer price index instead of into goods versus services, which is an often way to see the differences in where inflation still is high and where it's come down, instead break it into discretionary versus non-discretionary categories, or wants versus needs. And the discretionary categories of CPI, we're down to close to the flat line,
Mm,
basically no more inflation, which is just a rate of change. Whereas for the non-discretionary components, it's still running at about 5%.
yeah.
And that also helps explain the angst down the income spectrum, where a larger share of take home goes to those needs categories, whether it's insurance or healthcare costs or shelter costs or transportation costs. So I think that that's another aspect to this cycle that makes it so unique.
Yeah, this and the CPI, I guess the criticism there is kind of feeds into the shelter market, right? So the big
Yeah.
component of the CPI is owner's equivalent rent. We can discuss for hours the
It's
flaws
such a
there.
funky, it's such a funky metric. It's basically asking homeowners what they would be able to get for their house if they were renting it,
Yeah.
as if that's some sort of accurate proxy. But it's been sticky on the high side and has not followed down yet any of the real economy rent metrics.
Hmm.
But it is what it is.
Yeah.
Yeah, but keep in mind that the Fed's preferred measure of inflation is the PCE, and that
Right.
has less of that funky shelter component. So, and that's been more benign. So that's good news in terms of Fed policy.
Yeah, I think that, obviously closer to their 2.0% target than CPI is. And really getting into the housing market, I think, maybe a little bit of the focus of the Fed is to, the yield curve is normalized between twos and tens now.
Yep.
Hopefully the ultimate goal is to get the full uninverted yield curve, which is great. Mortgage rates obviously dependent out there on the 10-year supply of housing. And I think, housing is an important component that people potentially overlook from a spending side, right? So much goes into uh, a construction of housing, furnishing the housing, all the things that go along with that. And that's on the new front. But the existing market, which is really, in my opinion, has been locked
Oh yeah.
based on the zero interest rate policy to the aggressive raise. There's kind of a people floating out there saying, I'd
Well,
like to
yeah,
move, but why would
because
I?
well, at the peak in the 30-year fixed mortgage rate, which I believe was 8.2%, the average effective mortgage rate by homeowners was 3.7%. And that's been trending higher, but there's still a three handle
Mhm.
on that. And so that is what, to your point, that's what's frozen the existing home market. Even if you wanted to move, the idea of basically, selling a 3.5% mortgage to buy an 8% mortgage was just untenable. And that has kept the supply so limited. And the existing home market is more than 80% of the supply. So you can have a lot of freeing up and activity in the new home side, but it doesn't move the needle all that much given how much bigger a share of the market exists in the existing home side of things.
Yeah, and I know that again the volatility in rates has been pretty tremendous. So we see a week to week jump in mortgage rates and so forth. So again, more housing data to come. You mentioned the Fed meeting that happens this particular November, the day after election day or 2 days after election day. Probably not on by accident. But again, I think, and we get a November employment report as well. Um,
Yeah, so we have one more big jobs
yeah.
report in addition to the interim labor market data like weekly unemployment claims. But
Mhm. Yeah.
yeah, so from an election perspective, I think the biggest risk from a volatility driver perspective, maybe obviously, would be if it's close and contested,
Yeah.
and then it becomes an era of uncertainty potentially, up to inauguration day. And so how the Fed would potentially take that into consideration, I suppose to some degree it depends on market reaction. Even though
Yeah.
they don't key decisions off of what the equity market or the bond market is doing, it's got to be a feeder if that scenario unfolded.
Well, I mean, it's a big driver of consumer confidence, behavior, even on the business side, right? I mean, I am sure that we're seeing a bit of a slowdown on the business side with,
Absolutely.
a contentious, what most likely a contentious outcome. Um, Probably not settled on November 5th, but not to dive too much into that. But why would investments be made today with 20 days left or
Right.
21 days
And
left?
that's why you've seen it in CapEx plans and CapEx intentions have really been dented. And that's something that it wouldn't surprise me to see free up fairly quickly once the outcome is known after maybe digestion of, okay, not just who won the White House, but what is the makeup of Congress. Always important because, and it drives me crazy when I see these headlines on either side suggesting, immediately, after inauguration, this is what's going to happen
Yeah.
based, on some sort of policy, tax, or regulatory, as if it's just a wand wave.
Hmm.
And even people that should know better headline it that way, and that's a little frustrating.
Yeah, no, I think, and obviously we're right in the heart of it, so we're seeing lots of policies come out and this and that, and obviously our jobs have a lot of a psychological component to it, which for investors is trying not to do the wrong thing at the wrong time,
Yeah,
exacerbating it time after time after time. So this period of time obviously is very important to keep sort of that level head, that longer term view of, and again, statistically, it really doesn't matter who wins
correct.
party wise, who wins the White House. There's statistics on both sides. There's plenty of 7 or 8 different scenarios to analyze. I think the our premise is the makeup of Congress is most likely more important because of what you just said.
And no
Capital,
matter
yeah,
what, it's probably going to be tight enough that we have to really sort of temper assumptions about what becomes policy, even on the most base level of the assumption of Trump wins and all the tax cuts get extended, or Harris wins and they expire and taxes go up across the board. Well, not every Republican is in favor of extending those tax cuts and vice versa. So
right,
even if it's a sweep by one party or another, it is still, you can't make assumptions. So that's what our team in Washington has been trying to communicate.
right. Well, it's always helpful when Congress is in session too. So.
Well,
Um, no, so again, election, again, another headwind that we're facing here, but the markets, the equity markets in particular, are really looking through a lot of things that could have really negative implications. We just talked a little bit about policy. We have geopolitical events. We have, an earnings season that looks like it's off to a relatively good start, but the expectations have been ratcheted down.
right.
So there's kind of a low bar there, but um, and we've had a market that's been driven, an S&P anyway, that's been driven by, you know, a very narrow subset of companies
Until
uh,
recently.
until recently. And
Yep.
we had the same conversation through last year until pretty much the end of the year when it started. So do again, you've written about the broadening and we've started to see evidence. Is that something that, again, has some merits and has some legs, or do we go back
Yeah,
to a
I think the broadening does have legs, but I would couch it in a, this rotation we've seen is not a simple shift from all the market performance being driven by the Magnificent Seven to now none of the performance driven by the Magnificent Seven and everything else is working. It is not as binary as that. What started to happen in the middle part of the summer is we saw a bit of a corrective phase up the cap spectrum in tech and comm services, inclusive of the Magnificent Seven. We initially saw a rotation in conjunction with the telegraphing by the Fed of, okay, we're moving to an easier monetary policy phase. You saw that leadership shift initially to those interest rate sensitive areas of the economy, like real estate, like utilities, like financials. But we've had periods where when the China stimulus was announced and there was hope that we were going to see an improvement in global growth, that provided a lift to industrials and materials and energy. We've had days and weeks where attention and money has rotated and shifted back to the large cap tech names. So I think that's what's likely to continue, is sort of a rotation wrapping in other segments of the market, not some, well, we're now looking at the complete opposite of a market backdrop. In addition, you're right to point out the resilience of the market, how well the market has done in the face of these headwinds and uncertainties. That's true, but largely just at the index level. So the indexes, the S&P or the Nasdaq, are cap weighted. So if there's relatively good performance by the mega cap names, you multiply that price performance by their size, and that makes them large contributors to performance. But here's the relevant stat here, and I'll use the Nasdaq because it's a more extreme example, but illustrative. So the Nasdaq has had only a 13% correction this year from peak to trough, and that was from the mid-July to early August period of time. But the average member within the Nasdaq has had an average maximum drawdown this year of 45%. That is deep bear market level. It just also happened via rotation. and not the bottom falling out all at once. But if you were only looking at index level changes, you wouldn't have seen it. Even within the S&P hasn't had a correction this year. The maximum drawdown over that same period of time, mid-July to early August, was 8%.
Mhm.
But the average member within the S&P 500 has had a maximum drawdown of 19% and change. So I think the fuller story of what's been going on is told not just at the surface level, but under the surface.
Yeah. Are you, again, valuation on the S&P, 21, 2 times. However, are you a fan of stripping out the top X and saying the other
Well, yeah,
493 have a
yeah,
16 or
yeah.
17?
I mean, am I a fan of? I'm not actually a huge fan of valuation analysis to the extent people think it's a good market timing tool, which it's not. And there is no such thing as a good market timing
Yeah,
tool.
right.
So, but I think too often people think, oh, well, the market or a stock or a group is too expensive, so I shouldn't buy it. It just doesn't drive what markets do. If you were to, plot in a scattergram and your horizontal axis were different ranges for the S&P's PE, and then you were to plot on the vertical axis the subsequent 1-year return for the S&P from those start points of different valuation levels, the dots are literally all over the place. There is no trend line, there's no relationship. If instead on the vertical axis, instead of plotting subsequent 1-year return, you did 10-year return, then there's a closer relationship. Cheaper markets tend to have stronger returns 10 years out and vice versa. But as far as stripping out, um, it's something that I think illustrates the extremes that have come about with what has been a very concentrated market, and that the Magnificent Seven has more than a 30 multiple. Whereas, X the Magnificent Seven, you're in the, mid to high teens. You can do the same thing if you compared the PE on the equal weighted S&P with the PE on the cap weighted S&P. So I think it's helpful to understand the biases, but none of that suggests some, buy point or sell point timing of either, the Magnificent Seven type of stocks or the others. It's good for sort of the background, but absolutely not anything resembling a market timing tool.
Yeah, I'm glad you brought in the equal weighted S&P because lots of people are talking about that now with again, big divergence over the past few years of growth and value and so forth. And I think there's plenty of gray in there when you look at quality. And I know
Right.
that it's one of the things that you stress a fair amount, especially down the cap scale.
Yeah.
If you're talking about the Russell 2000 participating in a broadening, it's really lots of components of the Russell 2000 are not profitable companies.
43% of the
Yeah,
Russell 2000 are not profitable, and that has been trending higher recently. So one would assume that given decent earnings outlook for other indexes like the S&P, that maybe we'd be finally pulling out of the doldrums, but the percentage of non-profitable companies has actually been rising. One more FYI, it's not a recommendation to buy one index versus another. That's not what I do, but Russell 2000 is certainly the most commonly referred to benchmark of small cap stocks. It's certainly used as a benchmark more often than not for small cap money managers, but the S&P 600 is also a small cap index, and S&P uses a profitability filter. So it has I don't know off the top of my head what the percentage of non-profitable stocks, it's a fraction
yeah,
of what it is for the Russell 2000. So the point is, I think when moving down the cap spectrum, don't sacrifice quality, don't sacrifice profitability. There are opportunities to stay up in quality while going down in cap, and that's been our mantra.
yeah. No, I would definitely agree, regardless of cap. And I think that's what that gives people credence to get off of the valuation. Are they worth it? Is it worth a
Right.
long-term investment? To maintain and live through some expected volatility, which again is a theme I think for most people going forward, at least for the foreseeable future, is that we would expect a fair amount of volatility to start creeping into the market, even though it really hasn't been creeping into the VIX or any other real volatility measure. It's been creeping up a little bit, but certainly not.
Well, more of the volatility has actually been on the fixed income side of
Yeah,
things than on the equity side. So the equity market finally was able to just hand the volatility baton off a little bit and said, "Look, give us a break from some of this volatility. Let you deal with it for a little while." So I think that's been where the volatility has resided.
yeah. And again, just sort of final point on that small cap topic is, obviously much more rate sensitive
Yeah.
in that group than the large cap than their large cap counterparts. So again, a potential avenue for growth looking out into 2025 may be sort of that reinvigoration of maybe a little bit more of a banking cycle, consolidation cycle, something like that. But again, looking out at 2025, again, regardless of the election results, hopefully a smooth transition. Um, what are we missing from a risk standpoint here in the markets that isn't really being talked about? Uh,
Well, maybe it's being talked about because we just talked about it, but I'm not sure if it's being fully digested by markets, which would be a contested election that
yeah,
got really ugly. And so to suggest that the markets, I'd say that plural, fixed income side of things, equity side of things, even international, could just sort of ride through some, multi-month period of that kind of uncertainty, I think is a bit naive.
mhm,
Um, Obviously, something in the world of geopolitics and the wars becoming much more broad, elevated, escalated, particularly if it worked its way through the energy markets and the oil markets and the supply side. That needs to be a consideration. I think everybody has it as a consideration, and it's not the base case, but and so it doesn't represent a true black swan. But I also don't think it's a risk that is fully priced into the market. And then the other one I'd say is, and again, certainly not our base case, but another, and it might be tied to things like the war, um, a big acceleration again in inflation
yeah,
that would cause the Fed to not just, well, maybe we just pause for a meeting and reassess. But what, of course, none of us want is a repeat of the 1970s of sort of fits and starts of monetary policy driven by inflation having these big decelerations, then victory declared, only to see inflation, skyrocket again. That is definitely not in the cards. There's different views as to where inflation goes from here, but a 70s style, inflation's been fully let out of the bag again would clearly be one of those risks.
right. Yeah, there's been a couple of I've seen a couple pieces out there, not by other firms about that reacceleration risk in inflation, and not to the 9% magnitude, but more in lines of +5, maybe a little bit higher than 6, being a very big derailer
Right.
of what the Fed is trying to accomplish. So, again, I think
And it would, if that were to happen, it would probably be more on the supply side of things.
yeah,
Major disruptions from a supply standpoint. It's hard to see it being purely demand driven, but
right.
it still would be uncomfortable regardless of the cause.
Yeah. Well, like an East Coast port strike or yeah.
I think we might have had something like that.
Yeah, that again, one of the things I wanted to touch on earlier when we were talking about the employment situation was an event like that. We have Boeing, we have the potential ports heating back up.
Yep,
They only kick the can down the road till the end of the year
that's
on
right.
that one. So again,
How about throwing tariffs into the mix too? Which,
yeah,
regardless of whether you're pro or anti tariffs, I have yet to see any analyst, economists suggest that they're not inflationary.
yeah,
So there's that component to the inflation story as well.
yeah. Well, as I said, we could broach lots of different topics, especially on that front as well with what's going on. But I think it's probably more prudent to wait and see how things evolve from a
Yep,
policy standpoint.
yep,
But kind of discouraging a little bit is the fact that both sides of the coin are looking at increased budget deficits,
yeah,
and so forth. So we'll have to solve for that at some point in the future. But again, for right this second, the message has been, and I think you've articulated that quite well, is there's lots in the headlines, but underneath the surface, there's plenty going on that would lend evidence to support staying invested in markets and not making any sort of knee-jerk reactions
right.
based on what would be perceived as short-term events.
That's right.
So, that being said, again, I don't want, I want to be respectful of participants' questions. Again, that chat function is open. The Q&A tab is open for any questions on the macro environment. Let's keep it very high level and equity focused, or anything else that's on your mind that we can assist with, probably offline. I'm going to pause one quick second to evaluate that. Nothing's on anyone's mind. It's amazing.
Can I do a couple of my fun facts related
Yes.
to the election?
Yeah.
So one of them has to do with perceptions that people have with regard to candidates or parties in the past and the future around, well, this party or this candidate is good for, fill in the blank, or bad for fill in the blank. So one example of how this actually doesn't really work in reality would be the energy sector. So the energy sector is one of 11 sectors in the S&P 500, and those sector classifications go back to the early 1990s. And the energy sector is all traditional energy companies. In fact, we think of the tech sector as being top heavy with some of the big names. Boy, the energy sector is really top heavy. ExxonMobil and Chevron are close to 50% of that sector. But the rest of the stocks representing that sector are all traditional energy companies. They're the E&P companies, the drilling companies. There's nothing solar in there, or alternatives, or green energy, renewables. It's all traditional energy. So you would think, and I people say this to me, or and I read the headlines all the time. Trump is pro traditional energy, Biden Harris is pro, green renewables, et cetera. Well, here's what actually happened. So from inauguration day to inauguration day under the Trump administration, the energy sector was the single worst performing sector by a massive margin. It was the only sector down. It was down 40%. The next worst sector was up 20%. Fast forward to the Biden-Harris administration, from inauguration day to yesterday's close, the energy sector is by far the best performing sector, even beating technology, which is number 2. The point is not to say, wink, wink, nod, nod. Secretly, Trump is pro anti-traditional energy and pro solar and wind farms, and wink, wink, nod, nod. Biden Harris were secretly pro drilling and fracking and traditional energy. The point is, there are so many other forces that drive what markets do, what sectors do, what stocks do. We have to get out of our head of tying it to a candidate, a political party, a person in power. It just doesn't work that way. And then the real punchline to the way to think about elections is, if you were an investor in 1948, so the post-World War II period of time, and you invested $10,000 in 1948, and I'm going to use round numbers here, and only had it in the market when a Republican was in the White House, that $10,000 by the end of 2023 had grown to a little more than $300,000. If instead that $10,000 was invested only when a Democrat was in the White House, it had grown to 1.2 million. So there are people that stop the analysis there. Most likely it's going to be a Democrat that says, see, 4 times better performance over that span of time. That's factually true. That's just math. But if you invested $10,000 in 1948 and didn't care whether the Oval Office was painted red or blue, by the end of 2023, you had almost $38 million. So I'm guessing you're in my camp of I'll take the 38
What's
million
your choice? Yeah, exactly.
and let the 1.2 and the 300 battle it out for some form of party supremacy.
Yeah, yeah, exactly right. I was, that was that was in the election piece, and I wanted to reference that. So I'm glad that you did because it's a very powerful statement, and longer term charts are very powerful when you're trying to tell somebody the direction of markets
The
because
time in the market versus timing the market. It's
that's right.
just an election specific example of that.
That's right. And that's what we're up against. And the energy comments, very well received. It's actually, it's interesting because again, speaking about it, we're going to drill, we're going to do this, we're going to do all that stuff, bring energy back. We've seen a couple different interesting dynamics, energy related from some tech companies. I think Google today and Microsoft. So is the nuclear era coming back?
I think it's an everything and all approach, which makes a lot of sense right now, as opposed to sort of shunning a lot of different components of how we get energy. I think that was one of the important lessons learned across the board from a political party perspective is that there's the altruism of let's switch to a world of green energy, but there's the reality of the transition timing. And what's interesting is some of the I'm 100% Norwegian, so my family goes back generations in the world of the traditional oil that Norway is just filled with. But some of the most aggressive sort of renewables and green energy technology, and that country is at the forefront of thinking about the future, have been invested in and created by and worked on by the traditional energy companies that just say, you know what, we've got the people and the money and the manpower and the technology, and we see the writing on the wall in the future. So let's corral some of those resources to what is representative of the future. And so I think it's an and, not an or.
Yeah. And it, again, could prove to be a very wise business decision to secure your power supply
That's
for
right.
data centers, everything. We haven't even, I mean, AI could have been a topic that we discussed for
Utilities have become a bit
hours.
of an AI play.
I was shocked. It was a couple weeks ago when utilities became, at that point, the second best performing sector of the S&P on a year-to-date basis. It was a few
The
weeks
best
ago.
performing stock in the S&P is a utility stock.
Yeah,
Better performance than even Nvidia. So
yeah.
yeah.
So yeah, lesson learned. But this, your thoughts there have spurred a couple of different sector type questions. So I'm not, again, healthcare is one that's on lots of people's mind, and we could have tied in kind of in the employment conversation a little bit of the dynamics of the aging population, and this is a global phenomenon, not just here in the U.S., but healthcare as a sector has always been traditionally a defensive sector. Now that kind of a lot going on, it's a large sector. We have,
Yep.
I know we don't want to breach into different subjects here, but our GLP-1s curing everything. I mean, that's been a dynamic that's going around the sector, but
I think the healthcare sector is incredibly exciting right now and dynamic, not just for some of those innovations, but also healthcare as a broad sector was forced into the modern era from an efficiency perspective. There was so much low hanging fruit of inefficiency in that broad sector. And I think COVID and the shutdown really forced, whether it was getting things into electronic record form and the sharing of information, the advent of artificial intelligence and what that means in terms of the diagnosis of diseases. It is really exciting. We right now Schwab has a market perform rating on this sector. We don't have an outperform, um, uh, mostly just because of valuation and growth related concerns. But thinking outside of just overweight, underweight type recommendations at the sector level, healthcare is really exciting. You're getting the startup culture coming into healthcare in places like Nashville. That I just think it's really an exciting area that brings in technology and that startup culture and artificial intelligence. And I think it's going to be really fascinating to watch what happens in that sector, especially as it relates to AI.
Yeah, it's and so broad too. It's, you go from insurance to, large pharma to, innovative tools and diagnostics and life science,
And biotech, yeah, it's really
yeah.
it's exciting.
Yeah. So targeted lots of components that go along with that. So I'm glad that, you brought up some of those topics and we're able to touch on some of those. I think that's answered lots of our client questions. And again, I can't thank you enough for spending the time with us here
My pleasure.
today and sharing your insights. I know that, we value the partnership and it gives us, this opportunity in particular, which benefits our clients, so much. So
Well, we
again,
value the partnership as well. And I, by the way, I grew up the first half of my life in Morristown, New Jersey. So little bit of the backyard thing.
there you have so Norway to Morristown. There you go. Well, great. Certainly appreciate your time,
My
Lizanne.
pleasure.
Have a great rest of your day. And for all the participants, thank you for listening in. We value your feedback, so please feel free. Enjoy the rest of your day, and we'll end it right there. Thank you.
Thank you.